Welcome to Berkeley Middle East. This is CFA video series. Today we are going to discuss the topic called financial statement analysis tools. Mainly we are going to discuss the ratio analysis. This topic is the most important, practical and very deep discussing topic in the full CFA level 1 program. For any kind of financing, the starting point is always financial statements. Financial statements includes balance sheet, income statement, statement of cash flows, statement of changes in equity, and the additional disclosure which supplements the stakeholder or the viewer of the financial statement and helps to understand about the figures and operations of the company. Now, if you go for a loaning to any finance house, any bank or any financial institution and you are looking for the loan, the first and the most important question asked by them is financials. Once they get the financials, they start analyzing by using the tools of ratio analysis. What is a ratio? We will discuss today. And what are the kinds of ratio which helps us to understand as an analyst regarding the financial strength and operational efficiency of the company. We need to know that is the organization is healthy, this organization has enough cash to survive, to pay their short-term obligations, and on the same hand they are able to survive in the long run by paying their long-term obligations, and then how efficiently they are working in the business economy, and the overall efficiency we see from certain variables like how many days they take to sell a stock, how much days they take from the payables to pay them, how much days they get the money from the customers, how much time is the stock takes to reach to their warehouse, and it takes time to produce and sell and get the money from the customers. So how they manage their operating cycle. These all considerations are very important to understand the financial strength of a company. Today in our lecture we are going to discuss in detail certain kind of the ratios and tools which are very important to understand for the company where it stands. Now, once we will going for that one in CFA level 1, we are not required to memorize the formulas. In fact, our major emphasis will be on how to use it, what this ratio is directing towards, which way we want, and how to use this technique to get the highest possible assurance of the analysis of the financial statements. Broadly, we are going to discuss financial analysis techniques, then financial statement analysis, how we can apply in the real world, and in the last we are going to discuss the international standards convergence. First of all, we need to learn how to compare the financial statements. Surely, ratio, if you look the ratio of a company, it is not going to help you as a stand-alone. You have to compare, you have to make comparison between this company and the same level company in the industry, or you should know the industry standards, because every industry has its different ratio results. For example, if you are talking about a restaurant, every restaurant works on cash basis. When a customer eats something, he pays cash immediately. So for a restaurant, cash position is always positive. But for a steel industry where you are selling on 3 months, 4 months credit, surely you will receive your cash later, and there will be a sufficient gap between the cash, the sale has been done and the cash has been received. So the ratio for a restaurant industry is different from a ratio from the steel industry, from a manufacturing industry. This we have to develop a vision while analyzing the ratios, that what are the industry trends, which country we are operating in, what is the standard practices, and somehow it is going to link with the economy, with the environment, with the certain external factors which are going to influence your internal ratio understandings. What are the laws, what is the tax structure, and what is the interest rate, what fluctuations they have. This is ultimately very important while you have one ratio analysis with you to think it in a practical way. Then we are going to have, we need to discuss the limitation of the ratios. If your ratio is good or bad, this is we can decide certain factor which we'll discuss today in this lecture. But surely ratios are based on some assumptions, and these are based on your financial figures, and financial figures are taken on the historical cost data. So surely you have limitation in terms of analyzing the formulas, and because it is not going to incorporate the market changes itself. So this any analyst has to identify certain points which need to be adjusted while relying on the financial ratio techniques and analysis. Then we have to classify the financial ratios. Broadly, we are going to classify in a sense that if we want to check the company has capacity to pay the short-term obligations, we are going to check the liquidity. Liquidity is an accounting term which shows that how much company is capable to pay its short-term obligations, how much cash they have. Because some companies might be, you can experience that they have invested billions of dollars, but they didn't keep the cushion for the day-to-day expenses, and sometimes they are facing with the cash crisis, that the salaries, the expenses, the utilities, they are struggling with the cash to pay them, and it creates a great stress on the sustenance of the company itself. So we have to see what is the liquidity and the power to pay, and the capacity to pay the short-term obligations. Then we have opposite to this, if you want to check the long-term ability, we have gearing ratios. We have to check the leverage, which again has two types. One is operating leverage and financial leverage, which we'll discuss in detail today. And then we can check the activity, how efficiently company is operating, what is the quality of the operations, how efficiently we are using. We can see how many times the stock is being sold, and what is the average turnover period, what is the average collection period, what is the average payment periods. These certain things are very important to see the operational efficiency of the company. Then we will discuss about profitability. We divide sales with the gross profit. We see the net profit in terms of sales, which guide us that what margins we are adding, and these margins are adequate to cover the losses or to save us from losses and to increase the profitability of the company. Because at the end of the day, whatever operations you do, your purpose is to earn the profit and to maximize the shareholder wealth. So these profitability ratios are a good trend and a good sign and a very important judgment to start and base your financial analysis. Then we will discuss the valuation ratios. These ratios are based with mostly with the equity portion. you have to calculate the earning per share, then you have to, sometimes you go for a diluted earning per share, and anything related to the stocks, and we have to use the valuation, and we will learn in this lecture how to go for the valuation ratios. And then how can we relate these ratios into how we can see the operating, the leverage, and then the liquidity and this valuation, how it links, how to study as a comprehensive model. This we will discuss shortly. Very important in a traditional model, DuPont model, which was introduced way back, but it all still create a milestone for the companies. It has certain ratios to go for it. We will learn today what these are. Then ratios used in equity analysis, credit analysis. This customer is, should we trust this to lend, and what are the ingredients he should have, how old the company is. For understanding it more comprehensively, you assume if you go to a finance house, financial institution, or a bank, and you need some loan, so once you sit with them, they will give you a long list to comply with. What is that list is how old your company is, means 3 years, 5 years, vary from their requirements. Then they also need your certificate of incorporation. Then what is your trading activity, means you belongs to real estate, you belongs to the manufacturing company, you belongs to which industry. And then they see this industry is in a boom, it's in recession, is not a trend that everyone is coming making a real estate and all loanings is going in the real estate portion. This is a major consideration when you make the portfolios, which we will relate this concept with the portfolio management in the later portions of our CFA level 1 course. Then surely they are going to ask for your financials. Once they get the financials, they will check all these ratios as we discuss: operating, activity, liquidity, gearing, and based on there, then surely they are going to see the micro and macroeconomic indicators, how it helps them to understand that this company they should trust to give the money. So multiple factors will be considered before going for loaning or some lending arrangements by some financial institution.